What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing a stock analysis on Procter and Gamble. Now, if you're new to the channel, my name is Leo, and what we like to do here, folks, is look at companies from an objective value investing standpoint. So we're going to look at the fundamentals, the financials, and finally determine a fair price to pay for Procter and Gamble. So we're going to load this up in the stock research tool, and let's jump right into it. So load this up. Oh, that's not what I want. I want this. That's the screen that I want. So here's Procter and Gamble loaded up in the stock research tool, and we're gonna jump into our first category, and that is the company metrics. Now this is the window I want right now. What we like to do here, folks, is we like to compare the 5-year numbers over to the trailing 12-month numbers and see where the company currently stands and see if they're improving in certain areas and just try to gauge where the company is going. So with Procter and Gamble, we're seeing a little bit of a decrease in a 5-year PE ratio, which is good. We want that number to be underneath 22.5. An increase in EPS over our 5-year average. Return on equity is up. Profit margin is up. So right off the top, first 4 categories right here, looking pretty good. Now with our revenue sitting at $78 billion, that is very impressive. With a net income of $14.51 billion, free cash flow at $14.89 billion, this company knows how to move some bills, folks. That's the impression that I'm getting, especially seeing how we are up on our 5-year free cash flow number at 12.8 and 12.5 billion. Now, something to keep in mind here, folks, this company does pay a dividend, and it's sitting at 2.19%. Now, one thing we want to keep in mind here, folks, we're paying out $8.3 billion in dividends. Just keep that in mind. And why that's important is because a dividend is never always secure. So the only way to really understand if it is secure is comparing it to the 5-year average of free cash flow, which sitting at $12.5 billion, that's easily could be paid out. However, that is a very steep number. That means we're left with $4 billion worth of cash flow that we could pay for other things. So the dividend definitely takes up a large chunk of that number. I don't know how I feel about that. But nonetheless, it is safe. But we'll see if that makes sense to be allocated over there. Now, with our return on invested capital, very high number of 21%. And our 5-year average is still pretty good, but we've improved upon that number. So that is phenomenal to see. Almond Z-score is sitting at a lovely 5.27. We want that number to be over 3, and that we have that. And Piotrowski score sitting at a 7, which is pretty good. We want this to be between 7 and 9, so 7 is a fairly decent score. Right off the top, folks, objectively looking at Procter and Gamble, this is a $380 billion company. Interesting. I gotta say, I'm liking it so far. The only thing that has me somewhat mildly concerned is how much we're paying out to dividends with our free cash flow number. However, they are up on their free cash flow currently in their trailing 12 months. So I'm not too concerned, but out of everything that I'm seeing here, that is something that has me a little bit flagged, if you will. But it's nothing crazy. Anyways, let's jump into our next category, and that would be the financial evaluations, where we're going to score this company out of 10. So switching over, load it up, here we go. And we're scoring this company a 6 out of 10. So let's go through the positives first, where Procter & Gamble is earning points. Now, of the categories, return on equity, we have it at 22.70, and that is phenomenal. We want this to be over 15%. We have that. That's great. EPS growth. We're seeing growth over the last 5 years in earnings per share, so we have that. Phenomenal. And jumping into this lovely section of points, this is where the strong points are made. So share dilution, we're decreasing shares of 0.9, almost 1% of shares have been decreased over the last 5 years, which is phenomenal because as a shareholder, we want the company to either be decreasing shares or keeping the share count the same. And when they are decreasing shares, that means you own more of the business, which is great because that means that's more money in your pocket. That is a silent killer, folks, so just keep in mind for that, but they are doing a great job in helping out you, the shareholder. Now, 5-year free cash flow, that is up, 66% increase, which is great. return on invested capital, we want that over 10%. We have it at 15, and as we discussed earlier in our company metrics category, it's sitting at 21% for a trailing 12 months. Guys, phenomenal numbers. Phenomenal numbers. 5-year revenue growth is at 3%, so it is a slow growing company. Now, granted, listen, folks, it's a $380 billion business. It is a consumer household product business, so look, it's a behemoth of a company, so it is expected to be slowing in growth. Now, where does Procter and Gamble lose points? Well, let's go through those zeros, folks. So 5-year PE average is sitting at 34. Now we want this to be under 22.5, as I expressed in the company metrics. We're down to 26, so it's not too bad. However, with this number here, we don't want to overpay for growth, especially at 34, and it is a slow growing company. It's going to be very interesting to see if we can justify this number. I highly doubt that, though. Current ratio sitting at 0.67. We want this to be 1.5 or higher. Now, with 1.5, that means it would have enough assets on hand to cover their liabilities, with some left in the bank. Now, with a 0.67, that indicates to me that they do not have enough assets on hand to cover those liabilities. So that is mildly concerning, especially since a majority of our cash flow is being allocated towards our dividends. So this is what I'm saying, folks. Even though a dividend is nice and you get that check in the mail, or into your account rather, there's other priorities that needs to be addressed. So with any kind of liabilities that we have on hand, that's some free cash flow that could be utilized to pay that off. So just keep that in the back of your mind here, folks. Now, debt to equity is another, just to, I guess, echo what's going on with this current ratio. 51%. We want this to be under 50%. Now, it's not the worst thing in the world. However, this just indicates to me that they're taking on debt to grow this business. We want them to be building equity within the business to grow it. And so they're slightly leveraged out through debt. We don't want that. And another big kicker here is that our net income has been decreasing. I'm going to just pull out for a quick second, and I want to see the income statement and seeing what is going on. So where are we losing? Okay, so there is a slight dip in net income. It's actually kind of been somewhat rocky a little bit. Gone down, down, up, up, but we ultimately down since our 2017 numbers. So yeah, so far it was looking good in the company metrics category, I gotta say, but now in regards to our financial valuations is looking somewhat, it's still decent. However, this net income is not getting me any points. However, this free cash flow growth is phenomenal. Now, let's jump into a price analysis, and what we'll do here, folks, is determine what is a fair price to pay for this business. But so far, my thoughts on Procter and Gamble is it's a solid business. It can easily pay out the dividend. However, this current ratio and debt that we have on hand, and if this net income continues to drop, that could be a potential problem. And it's also a slow growing company, so hard to say. We'll jump into a price analysis and we'll determine what a fair price to pay would be. Now, folks, if you are enjoying the video so far, consider subscribing. It helps out the channel a lot. It makes me feel warm and fuzzy inside. And yeah, if you want to see any company evaluated, drop it down in the box below. I'm happy to analyze any company you would like to see, put it in this program here. And if you're interested in obtaining this program, it will be an app available to you, and it should be coming out hopefully soon. It's in the works, it's in the motion, and I'm just trying to get everything finalized, and hopefully sooner than later. But this is a great program. I mean, I'm a little bit biased towards it because I built it, but it allows you to quickly research and analyze companies and try to find undervalued securities. So without further ado, let's jump into a price analysis and see what this company is all about. So here we go. We're going to do 3 different analysis, and we're going to do conservative, moderate, and aggressive. So what I like to do is try to stay as conservative as possible to give myself a decent margin of safety. I'm going to populate these boxes. I'll touch base with you in just a quick second and explain why I did what I did. So stay tuned. So taking a look at these numbers here, you're probably wondering why I did 1% revenue growth. Well, look, we're sitting at 3% revenue growth. I can't imagine over the next 10 years of this evaluation that this company is going to just get massive growth. It's just, I don't believe that's going to happen. So I stuck with a pretty conservative estimate for 1, 2.5, and 3 for 3% revenue growth on the high side over the next 10 years. Profit margin, I believe they'll probably stick within the numbers that we've established here within the 10 and 5-year numbers. So that's why I did 14, 14.5, and 15. Free cash flow margin, same thing, roughly within that 10 to 5-year range, because I believe they'll be able to hit those numbers. Price to free cash flow, I want to stay underneath 20, so I said 15, 17, and 20. Now, a PE ratio, look, our PE ratio has been decreasing. It's gone down to 26.37. Now, ultimately, as a company gets larger, you should be paying a lower multiple for this business. It doesn't make sense to stick at this PE ratio, especially over the next 10 years. So hence why I'm going 12, 16, and 18. Now 18, to be honest with you, this is a little bit on the high side, but this is my unicorn list. And essentially, this is essentially the wish list. I don't think this is likely to happen, but this is what would, if this happens, that's phenomenal. What I do believe, though, is the numbers I've put in my conservative and moderate category, this is what my margin of safety really is. So we're going to put a desired return in, 13% return. And folks, it's right across the board. $158 is our current price. $72 is our average calculations, meaning that if you pay $72 for the share price today, assuming a 13% return, you're likely to make that over the next 10 years. However, we're nowhere near that. On the low end, $52, moderate $73, and $90 for the high side. That is it's pretty rough. It's pretty rough. Price has to fall down in half. And honestly, look, at a lot of these companies that I've evaluated over the last several months, it's essentially just that. This is an overpriced market, folks. There's a lot of companies, and very rarely that I find a company that's actually undervalued. These are companies that, even though they're solid businesses, you could be overpaying for them tenfold. And Procter and Gamble is no excuse, and it is essentially one of those businesses. As well as bringing up the free cash flow again, paying out that large amounts of dividends. I don't like that it's allocating that much money to their dividends, especially if, let's say, over time, as growth decreases and they have to uphold that dividend, is their revenue going to decrease? Their net income is already decreasing. So is it a matter of time that their free cash flow decreases as well? And then are you allocating still more of your free cash flow to uphold that dividend and essentially have less left over to pay down debt and stuff like that? These are all things that could potentially snowball and cause a lot of hazardous scenarios for this business. So these are things to just keep in the back of your mind, folks. Like what could happen? What if this happens? And essentially that's what the approach that we're trying to do. Because look, if you're right on a company in terms of, let me rephrase. To be right on a company is you have to eliminate all the things that could potentially go bad. Because look, if a company goes up, you don't have to worry about that. The upside will just take care of itself. You have to worry about the things that will ruin a business. So these are things that I question. What happens if this happens? The what if, it's the what if scenarios. Now the what if scenarios may never happen. That their free cash flow will increase and they'll easily be able to pay off the dividends and pay off their debt and all this other stuff. But I always want to think in the back of my mind a little bit pessimistically, to be honest, what if they can't? Am I fine with that? And that's the questions you have to ask yourself. Am I fine if they're unable to do that? Am I fine if the free cash flow decreases and they're running on such a slim margin that they have left over from paying out the dividend? Or what happens if they cut the dividend? How are shareholders going to react? These are things you have to ask yourself. right? And this is where your risk management comes into play. If they cut the dividend, am I still going to be an investor? Am I buying it just for the dividend? Ideally, you shouldn't be. You shouldn't be buying any company for just a dividend. But do you have confidence in the management to make the right decision? Because this is what's going to happen here, folks. You know, this is probably one of those dividend aristocrat stocks that people buy in because it pays out a dividend. They're happy with the return. They're just going to hold it because of that little check that comes in. But if they say, you know what, guys, we want to focus on paying down our debt, growing the business even more, we're going to reinvest into ourselves, dividend is cut. Well, as a shareholder, listen, if that were to happen, and I've expressed this with my Intel video, I would say, awesome. You know what? Because that's more money in my pocket. Because now that's $8.3 billion that's going to be reinvested back into the business that they can now make some moves. Procter and Gamble is a large company that's been around for quite some time. I don't see them ever making that stance or making that play. However, it's just something to consider and think about, right? Because listen, as we expressed, current ratio is sitting at 0.67. We don't know what the future holds, right? We only know on how well the company is managed and the competence of the management team. Now, this is something I have to, I can dig deeper into the management and see if I truly enjoy like this company and dig deep and see what they're all about. But based off of my assumptions here, and I've gone really, look, 3%, not too far off, and I'm being really lenient with some of these numbers here. And we're sitting at $90 on the high side, currently $158. Yeah, it's a pass. It's a pass from me. But remember, do your own due diligence. These are just my thoughts, and that's what I think about Procter and Gamble. What do you think about it? Drop it down in the drop it down. Just drop a comment down below and let me know. And also, like I said, let me know a company that you want to see evaluated. Let's get a discussion going. What are your thoughts on Procter and Gamble? And I will see you in the next video. Thank you so much for watching. Until next time.